Hey everyone, welcome back to Corporate Decoder, the place where we unpack those dense financial reports and try to find the juicy bits. Did you know that companies are required to tell us almost everything about their money situation? Well, today we're diving into Core and Main Incorporated's latest quarterly report. And let's just say they've been busy with acquisitions and managing their finances. Before we dive in, if you like getting straight to the point and understanding what is really going on with companies, make sure you are subscribed. We also have a Discord community linked in the description below where we break down these filings and talk strategy. This is a Form 10Q, which companies like Core and Main Incorporated file to give us a quarterly update on how they are doing. It is like a mini checkup between their big annual reports. And this one covers the period ending the 2nd of November. 2025, the company itself is a big distributor of water, wastewater, and fire protection products. Think pipes, valves, all that essential stuff for building and maintaining our infrastructure. Okay, let's get to the numbers. Right at the start, we see their balance sheet, which is like a snapshot of what the company owns and owes. On the 2nd of November 2025, they had about $89 million in cash and cash equivalents. That is up from just $8 million at the beginning of the year, which is a pretty big jump in cash. They also show about $1.3 billion in receivables and nearly $1 billion in inventory. That means they have a lot of money tied up in things customers owe them and products they plan to sell. When we look at their liabilities, they have over $4.2 billion in total liabilities, with a significant chunk being long-term debt. Over $2.1 billion. Now let's look at their performance for the 3 months ending the 2nd of November 2025. Their net sales were about $2.06 billion. That's a small increase from the same period last year. But when we look at the 9-month period, sales jumped from about $5.7 billion to over $6 billion. That is a solid increase driven by more volume and some smart acquisitions. Digging into the sales a bit, the biggest chunk of their business comes from pipes, valves, and fittings. For the 9 months, this category brought in over $4.1 billion, up almost 6%. Storm drainage products also saw a good bump, up nearly 9%. The fire protection products and meter products lines also saw increases, mostly from their acquisitions. Now, how much money did they actually make on those sales? That is the gross profit for the 3-month period. Gross profit was $561 million, a nice increase from the previous year, and this represents about 27.2% of their sales. This is good because it shows they are effectively managing the cost of the products they sell compared to the price they sell them for. But selling stuff costs money too, right? That's where selling general and administrative expenses come in, or SG&A. For the 3 months ending the 2nd of November 2025, these costs went up to $295 million. That's a bit higher than last year, and it means a larger portion of their sales went towards running the business, like paying salaries and other operating costs. When you subtract those operating expenses from the gross profit, you get operating income. For the 3-month period, it was $220 million, a slight dip from last year. Even though sales and gross profit went up, higher SG and costs ate into that profit. This is something to keep an eye on over the 9-month period. Operating income did see a small increase to $604 million. Now, companies often borrow money, and that borrowing costs money too. That's interest expense. This report shows that interest expense has actually gone down to $91 million for the 9-month period compared to last year. That is good news, likely due to some favorable changes in their loan agreements and possibly lower interest rates. All of this leads to net income, the bottom line. For the 3 months ending the 2nd of November 2025, net income was $143 million, a small increase from last year. And for the 9-month period, it climbed to $389 million. The company also reported that net income attributable to Core and Main Incorporated, meaning what is left after accounting for other ownership interests, also saw a healthy increase, and for the shareholders, earnings per S-share or EPS is crucial. For the 3 months ending the 2nd of November 2025, basic EPS was 72 cents and diluted EPS was also 72 cents. This is up from 69 cents last year. For the 9-month period, basic S was $1.95 and diluted EPS was $1.94. So on a per share basis, the company is doing a bit better. Companies often use special metrics to show their performance because they think it better reflects their core business. One is called adjusted EBITDA. For the 3-month period, adjusted EBITDA was $274 million, a slight decrease. But for the 9-month period, it increased to $764 million. This metric excludes certain expenses like the cost of acquisitions, which they've been doing a lot of. Similarly, adjusted diluted earnings per share, which is how much profit is allocated to each share after adjusting for certain items, also increased. For the 9-month period, it was $2.45, up from $2.28 last year. Speaking of acquisitions, Core and Main Incorporated has been very active. They completed several acquisitions in the past year, including Canada Waterworks Incorporated, Green Equipment Company, and Dana Kepner Group Holdings, LLC, just to name a few. These deals are significantly growing their business, adding more product lines and locations, especially expanding their reach in Canada. They have quite a bit of debt, most notably a senior term loan credit facility. They have outstanding loans totaling over $2.1 billion. While they've worked to manage interest rates with swaps, rising rates can still impact their costs. They pay quarterly principal payments on these loans, but the bulk of it is due in 2028 and 2031. To manage the risk of rising interest rates on their variable rate debt, they've entered into interest rate swaps. These are essentially agreements to exchange variable interest payments for fixed ones. It's a bit like locking in your mortgage rate to avoid surprises as of the 2nd of November 2025. These swaps are having a significant impact on their interest expense and are recorded as assets and liabilities on their balance sheet. Now, for something a bit complex called tax receivable agreements, basically, when the company benefits from certain tax deductions, it has to share a portion of that benefit with certain stockholders. They've recorded significant liabilities related to these agreements, showing how a portion of their future tax savings will be paid out. Looking at their cash situation, they had $89 million in cash at the end of November 2025. They also have a large credit facility with over $1.2 billion available to borrow if needed. They believe they have enough cash from operations and available credit to cover their needs for the next year. When we look at the 9-month comparison, the story is one of growth. Net sales increased by over 5%, largely due to higher volumes and those strategic acquisitions. Gross profit also rose nicely, and while SG&A expenses grew, the overall operating income showed a slight increase. The company is managing its debt interest expense effectively, and net income is up. It is also worth noting that Core and Main Incorporated has been actively buying back its own stock. For the 3 months ending the 2nd of November 2025, they repurchased nearly 1 million shares. This can be a way to return value to shareholders and potentially boost earnings per share. They still have a significant amount authorized for future repurchases. Finally, there is a small disclosure about some of their directors adopting trading arrangements. This means they're setting up plans to sell shares over a period of time. For example, Orvin T. Kimbrough, a director, adopted a plan to sell up to nearly 28,000 shares, and Margaret M. Newman, another director, plans to sell over 38,000 shares. These are generally intended to comply with trading rules. Now, looking at Core and Main Incorporated's performance here, they seem to be navigating a complex business with a focus on growth through acquisition and operational efficiency. Their sales are growing, and they are managing their product costs well, leading to healthy gross profits. The increase in cash is a positive sign for liquidity. However, the rising SG and expenses, driven partly by those acquisitions and inflation, are something that could pressure profits if not managed carefully. Their debt load is substantial, but they are actively managing interest rate risk, and their access to credit seems strong. The company appears to be strategically growing its market share in essential infrastructure products, which is a resilient sector. The key risks will likely be integrating those acquisitions smoothly, managing inflationary pressures on their operating costs, and navigating the interest rate environment. But overall, they're demonstrating solid financial management and a clear strategy for expansion. Alright, that is our breakdown of Core and Main Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.